Welcome to Griffonomics.
Mm.
Imagine a brand new billion-dollar artificial intelligence data center just sitting out in the middle of the California desert.
Oh, yeah, like one of those massive hyperscaler facilities.
Exactly. I mean, the facility is a total marvel of modern engineering, right?
Yep.
Packed floor to ceiling with the latest, most incredibly expensive AI chips you can buy.
Right, and they run super hot, so you'd need like state-of-the-art liquid cooling systems.
Yeah, liquid cooling, fiber optic networks that can, transmit the entire library of human knowledge in seconds. Plus, this whole team of top-tier software engineers just ready to train the next generation of large language models. The tech giants, they've spared absolutely no expense here.
Right. But there's a catch, isn't there?
A huge one. Right now, this billion-dollar technological fortress is, it's completely useless because it's sitting in the dark.
Wow, in the dark.
Yeah, and the reason it's sitting in the dark is that the local electrical grid simply does not have the capacity to turn the thing on. The utility company is basically telling these data center operators, hey, you might have to wait 5, maybe even 10 years for a new power plant and new transmission lines to actually get built.
10 years. I mean, in the tech world, 10 years is an eternity.
Exactly. So today we're doing a deep dive into the stack of investigative reports, the earnings transcripts, and the proxy statements that you handed us, because you brought us this fascinating company that is quietly sitting at the epicenter of this AI power crisis. And they are charging an absolute fortune to solve that exact desperate bottleneck. The company is Willdan Group, ticker symbol WLDN.
Yeah, and what's fascinating here is the sheer velocity of this pivot. We are watching a company fundamentally rewire its DNA in real time because, our mission today is to really deconstruct what is happening inside Willdan. Because we aren't just looking at, a standard company trying to organically grow its revenue a little bit. For decades, Willdan was this legacy public sector government consultant. Very traditional, but now they are attempting to aggressively transform into a high-margin, fast-paced commercial energy powerhouse.
And looking at the documents you gave us, there's just this fierce, high-stakes debate playing out among Wall Street analysts right now.
Oh, absolutely. It's totally polarized. On one hand, you have analysts arguing that Willdan is basically the ultimate asset-light proxy for the entire AI energy boom. Like a brilliant way to invest in AI infrastructure without taking on the crazy capital risk of, physically building data centers or power plants.
But then on the other side of the aisle, you've got these intense skeptics pointing straight at the balance sheet.
Yeah, the bears. They're arguing that Willdan is actually this highly fragile working capital trap and that their current stock price is priced for absolute perfection, like zero margin for error.
Okay, let's unpack this. Let's start by contextualizing the scale of this pivot. Because if you don't understand their history, none of this makes sense.
Right, you need the baseline.
Yeah. So according to the foundational documents in our stack, Willdan was founded way back in 1964. And for the vast, vast majority of their existence, they were explicitly designed to serve public agencies.
Right, like acting as the outsourced city engineers for municipalities, that sort of thing.
Exactly. Operating local building and safety departments, managing massive public works projects. And because of that super specific history, their revenue has been overwhelmingly tied to utility and government spending cycles, like almost exclusively.
Yeah, look at 2024, the commercial side of their business, working for for-profit corporations. It was a mere 7% of their total consolidated revenue.
7%, that's practically a rounding error.
It really was. But the projections for 2026, they tell a wildly different story. On a pro forma basis, management is projecting that their commercial revenue mix is going to leap from that tiny 7% all the way up to 25%.
Wait. A structural reallocation like that, going from 7 to 25% in just 2 years, that does not happen organically.
No, absolutely not. You can't just casually grow a 7% sliver into a quarter of your entire business through standard sales channels.
Yeah.
Definitely not in the engineering and consulting space.
So what's the catalyst?
The catalyst is highly aggressive M&A. On May 4th of 2026, Willdan closed this massive acquisition of a company called Burton Energy Group.
Okay, I saw that in the filings. That was, a $52 million upfront cash deal?
Exactly, $52 million in cash. And Burton is basically the engine that makes this entire commercial pivot mathematically possible. By bringing Burton in, Willdan instantly adds about $103 million in contract revenue to the books, plus, around $7 million in trailing EBITDA.
But reading through the reports, it seems like it's not even really about the raw financial numbers. It's about the Rolodex.
Oh, 100%. Burton brings the oversight of over 60,000 distinct commercial client sites. And these aren't, small mom-and-pop regional businesses.
Right. They're managing energy footprints for massive Fortune 500 blue-chip companies.
Yeah. We're talking national retail giants, brands like Target, McDonald's, Home Depot.
So Willdan is basically just buying their way into the commercial sector. They're acquiring a firm that already holds the keys to 60,000 corporate utility meters across the country.
That's exactly it.
But I guess my question is, why the sudden urgency to abandon their bread-and-butter municipal work? I mean, the public sector literally kept them in business since 1964.
Well, the answer is buried in the Q1 2026 earnings call transcript. It comes down to the fundamental difference in how those two types of clients actually spend money. CEO Mike Bieber, he calls it the sales cycle dynamic.
The sales cycle dynamic.
Yeah. He points out that government clients take a, quote, more modest approach to schedules.
Modest approach.
Yeah.
That is a very diplomatic way for management to say municipal bureaucracy is agonizingly slow.
Oh, incredibly diplomatic. Because if you're an engineering firm trying to get a project approved by a city government, you are entirely at the mercy of the public funding apparatus.
Right. You have to wait for the annual budget appropriations to clear.
Yes. You wait for tax receipts. If the project needs debt, you have to wait for municipal bond financing to be underwritten. Sometimes it literally has to be voted on by the public.
And you're constantly dealing with city council debates, right? Like competing political priorities.
Yeah.
If a city faces a sudden budget deficit, your infrastructure project can just be delayed indefinitely.
Exactly. It's this slow, methodical, highly regulated environment. But contrast that with the commercial clients that Burton brings in. Corporate giants operate on a totally different wavelength right now, especially with the energy transition.
Yeah, the transcript captured management saying that commercial clients demand solutions, quote, immediately like yesterday.
Right. If Target wants to roll out a nationwide energy efficiency upgrade across thousands of stores to cut their operational costs, they don't want to wait for a public hearing. They want the ROI to start the absolute second the decision is made.
And that's where the whole margin expansion thesis comes in, right?
Exactly. Speed equates directly to margin here. Because these commercial entities demand that extreme, rapid execution, they are highly willing to pay a premium to bypass the slow procurement cycles.
Because they aren't forced by law to award the contract to the absolute lowest bidder.
Right. No mandatory public bidding process. They just award the contract to the firm that can mobilize a team and execute the fastest. Willdan is basically monetizing the urgency of the private sector.
It kind of feels like, trading in a reliable, slow-moving cruise ship for a fleet of high-speed race cars.
I like that analogy.
And the historical Willdan business model was like repairing massive cargo ships in dry dock. Steady work, huge contracts. But the ship is just sitting there for months. The margins reflect that slow pace.
Yeah.
Now they're becoming a Formula One pit crew. The work happens in seconds. The client pays an astronomical premium for that speed because it wins them the race.
And this is but operating as a high-speed pit crew introduces an entirely new level of operational friction.
Exactly. Which brings me to a huge question I have about this whole pivot. The government contracts might be slow to secure, yeah, but the proxy statements emphasize how incredibly durable they are. Some of those municipal contracts have been continually renewed for over 30 years.
30 years? Yeah.
So by shifting all this focus and capital to the fast-paced commercial space, aren't they actively trading away the incredible safety of the public sector just for a quick hit of margin expansion?
Well, that tension safety versus lucrative speed, that's the exact fault line the analysts are arguing over. But the nuance here in the documents is that Willdan isn't just binary about it. They aren't totally abandoning the public sector to chase retail.
Okay, so what's the hybrid approach?
They're trying to take that aggressive implementation mindset that Burton uses in the commercial space, and they're applying it directly back into their massive, dense, urban public markets. They want the public sector to behave a little more like the private sector.
Here's where it gets really interesting, because that brings us right to the developments in New York City. That feels like a massive strategic inflection point in the source material.
Oh, huge. Willdan recently secured a $27 million three-year contract to completely redesign and manage the NYC Accelerator program.
And they actually unseated a long-time entrenched competitor to win that bid, right?
Right. They did. And they strategically partnered with 8 local New York engineering firms to build this local network. The stated goal of the contract, like the reason they won the bid, is to fundamentally shift the program's focus away from just building energy awareness and move it directly into hands-on project implementation.
Okay, we really need to break down the mechanical difference between awareness and implementation here because it seems like the core of their whole urban strategy.
Yeah, so historically, an awareness program in a city is incredibly passive. It's just a consultant walking through a 60-story commercial high-rise, doing an audit, and then handing the building owner a massive binder.
Right, and the binder says, hey, your windows are inefficient, your 40-year-old boiler is leaking heat, your HVAC is drawing way too much power.
Exactly, and the consultant gets paid for the audit, but then the building owner just takes that binder and shoves it in a desk drawer.
Yeah.
Because replacing a boiler in an occupied high-rise in Manhattan is a terrifying, expensive logistical nightmare.
So the awareness is there, but the action is totally absent. So how does implementation change that?
Well, by shifting to implementation, Willdan isn't just diagnosing the problem anymore. They're actively stepping in to oversee the surgical cure. They're the general manager of the solution.
Meaning they bring in their own engineers to design the systems?
Yes, they vet and manage the third-party contractors doing the physical labor. They navigate the insane web of New York City building permits. They oversee the physical upgrades from the blueprint all the way to the final inspection. They're moving from the low-margin business of giving advice into the high-margin business of executing complex physical projects.
And the catalyst forcing these building owners to finally, take that binder out of the drawer and actually replace the boiler is this thing called Local Law 97.
Right.
The investigative report spent a lot of time detailing the mechanics of this legislation. Local Law 97 is a very strict, legally binding set of decarbonization mandates targeted specifically at buildings larger than 25,000 square feet in New York.
And we should clarify, we are just looking at the economic reality here, impartially. Regardless of anyone's political stance on climate mandates, the financial reality for the real estate owner is totally binary.
Exactly. The law establishes these strict emissions caps that get progressively lower and more punitive over the coming years. Building owners either spend massive amounts of capex to upgrade their efficiency, or they face crippling, recurring financial penalties from the city.
And Willdan is perfectly capitalizing on that exact economic reality. By running the implementation arm of the NYC Accelerator, they embed themselves directly into the compliance lifecycle of Local Law 97. They are sitting right at the choke point between the city's regulatory demands and the owner's desperate need to avoid fines.
So the city creates the pressure, and Willdan gets paid to release it.
Bingo. They convert a localized regulatory mandate into a durable, multi-year pipeline of recurring project work.
And the financial markets definitely noticed. Following the first quarter of 2026, management significantly raised their forward-looking guidance. They bumped their adjusted EPS target up to a range of $4.90 to $5.05.
And they raised the adjusted EBITDA target for the year to sit between $100 and $105 million. That's a projected 26 to 32% growth jump year over year.
Which is management basically signaling to Wall Street, hey, this transition isn't just theoretical slide deck material, it's actively accelerating profitability right now.
It's a massive vote of confidence, but it also really raises the stakes for execution, They're promising they can digest the Burton acquisition and scale up the New York project without missing a beat.
But wait, let's look closer at that New York revenue. The analyst reports keep using the term recurring revenue to describe the NYC Accelerator contract. But is regulatory-driven revenue truly recurring the same way? Like a software subscription is recurring?
That is a very fair pushback.
Because what happens to Willdan's multi-year pipeline if the political winds shift? Suppose a new city administration is elected in New York and they decide the real estate lobby is right, that the fines are too punitive and hurting the local economy. If the city council votes to roll back, delay, or just gut the enforcement of Local Law 97, the financial pressure vanishes instantly.
Right. The binder goes back in the drawer.
Exactly. If Willdan is relying on the government wielding a regulatory stick to force capital expenditure, aren't they leaving their newly raised earnings guidance highly exposed to the whims of municipal politics?
That is the precise vulnerability of being heavily concentrated in a single municipal ecosystem. The sources note that the New York market accounts for roughly 19% of Willdan's consolidated contract revenue. That is a massive chunk tethered to the political stability of one city. The regulatory stick can absolutely be taken away with a single legislative vote. But Willdan's strategic counterweight to that East Coast political vulnerability is what's happening out west. Because while New York is driven by the artificial stick of regulation, the demand out west is driven by an organic, terrifyingly real carrot.
The AI data centers.
Yes, the unquenchable, desperate thirst for raw electrical power from the artificial intelligence sector.
The internal Willdan studies cited in these documents regarding the Western electrical grid, I mean, they are genuinely staggering. They are projecting a 45 gigawatt generation gap in the Western United States by 2030.
45 gigawatts. It's almost hard to wrap your head around.
Let's break down where that shortfall actually is. They anticipate needing an extra 25 gigawatts of new capacity in the Southwest, mostly from the cooling demands of desert data centers. California alone is facing a 20 gigawatt shortfall, as its grid struggles with legacy infrastructure and renewable intermittency.
And don't forget the Pacific Northwest. Historically, they've had abundant hydropower, but they're hitting structural limits. They need capacity at 4 to 5 times their historical levels just to meet forecasted demand.
And the source material is totally unequivocal.
Yeah.
This unprecedented strain is primarily driven by the exponential build-out of AI hyperscale data centers.
We really need to quantify what a 45 gigawatt gap means in the physical world. A single gigawatt of electricity is roughly enough to power 750,000 average homes.
Wow.
So a 45 gigawatt shortfall. The Western grid needs to somehow generate the equivalent power required to run over 30 million homes in the next 4 to 5 years, just to feed these massive server farms processing AI models.
30 million homes. That's insane. And the reason this is an opportunity for Willdan is that traditional utility companies are physically incapable of solving this problem on that timeline.
Right. You can't just decide to build a new nuclear facility or a massive natural gas plant or even a utility-scale solar farm in 12 months.
But why not? I mean, if the demand is there and the AI companies have virtually unlimited cash to pay for the power, what is stopping the utilities from just building more plants?
It comes down to physical engineering bottlenecks and utterly broken supply chains. Traditional power generation faces multi-year development cycles. Before you pour a single yard of concrete, you have years of environmental impact studies, regulatory approvals, land acquisition battles.
Right. And even if you magically bypass all the red tape.
The physical supply chain is still gridlocked. The massive industrial gas turbines required to spin up new natural gas peaker plants, back-ordered for years. The specialized high-voltage transformers for the substations. Lead times stretching into the half-decade mark. The physical components required to generate 45 gigawatts simply do not exist on a shelf waiting to be purchased.
So the grid is maxed out, the supply chain for new plants is gridlocked, and the tech giants are screaming for electricity to train their models. Where exactly does Willdan fit into this?
Willdan inserts itself by acting as what the industry calls the efficiency gatekeeper. If a utility physically cannot generate more power on the supply side, the absolute only way to plug the gap and get those data centers turned on is to aggressively reduce demand on the other side of the grid.
Okay.
Willdan provides complex energy efficiency engineering, which they accurately position to investors as one of the most quickly available, least-cost electricity resources on the market.
That concept is fascinating. Least cost electricity resources. We usually think of a resource as something you pull out of the ground, like coal, or, harvest from the sky, like solar. But Willdan is treating the absence of power usage as a commodity. How do they actually create this resource?
The industry term is negawatts. A negawatt is simply a watt of energy that is saved due to efficiency. So Willdan dispatches teams of specialized engineers into massive commercial and industrial facilities, factories, retail footprints, office parks, and they execute deep structural retrofits. They might redesign the entire industrial HVAC architecture so it uses half the power to achieve the same cooling. They integrate smart, AI-driven sensors that dim lighting and power down non-essential machinery the millisecond it isn't needed. By drastically reducing the baseline power consumption of these commercial facilities, Willdan effectively frees up immediate capacity on the local grid.
Oh, I get it. Think of the power grid like a major multi-lane highway during rush hour. The AI data centers are a massive fleet of oversized commercial trucks that suddenly need to use the highway, but every single lane is already bumper to bumper with daily commuter traffic.
Right. And the traditional utility approach is to try and build 5 brand new lanes, which takes years.
Exactly. Building lanes means pouring asphalt, buying land. But Willdan's approach is entirely different. They aren't building new lanes. They go to the daily commuters currently on the highway and implement a hyper-efficient mandatory carpooling system.
I love that.
By taking thousands of individual commuter cars off the road, they instantly free up the existing lanes, allowing the AI trucks to merge onto the highway today without laying a single inch of new asphalt. They flatten the load curve.
That is the exact mechanism. But Willdan isn't just freeing up space on the highway, they are also physically building the on-ramps for those AI trucks.
The APG division, right?
Yes. The documents detail the rapid scaling of their alternative power generation, or APG, subsidiary. While the efficiency teams are out creating megawatts, the APG engineers are actively building the physical, critical infrastructure directly for the hyperscalers.
Like the electrical substations.
Yes. Designing and constructing massive substations, high-voltage interconnects, and the complex power blocks that step down the raw power from the grid to feed the servers. And because the market is so desperate, management expects the APG data center business to more than double and potentially triple in 2026 alone.
It's the classic gold rush theory. WLDN isn't out there trying to build a massive, risky gold mine like a new power plant.
Yeah.
They are selling the highly priced, specialized picks and shovels, the efficiency in the substations, to the tech giants who are desperate to start mining immediately.
Exactly. A legacy utility takes on billions of dollars of debt, secures land, and assumes massive execution risk over a decade. If regulations change or raw material costs skyrocket, the utility is left holding the bag. Willdan sidesteps that capital risk entirely. They don't own the plants, they don't buy the fuel.
So if they are selling premium picks and shovels at a massive markup, what does this actually look like when the cash hits the register? How does this translate to the income statement?
The first quarter numbers present a very compelling bull case on paper. Willdan's Q1 2026 adjusted EBITDA hit a record $18.1 million. That's a 25.4% increase year over year.
And the report notes that if you normalize the data, because the prior year's quarter had an extra week of billing, the normalized growth is actually closer to 35%.
Right. And alongside that raw profit growth, their gross margins expanded significantly, moving from 37.8% up to 40.7%.
The documents point to a really specific mechanical reason for that gross margin expansion. It highlights that subcontractor costs dropped down to 40.4% of total revenue. Why does the ratio of subcontractor cost to revenue matter so much for their margin profile?
It comes down to the accounting difference between pass-through revenue and self-performed revenue. In their legacy municipal business, Willdan might win a big public contract and then instantly hire a small army of third-party subcontractors to do the physical labor, pouring concrete, installing fixtures, whatever.
So Willdan is just the middleman.
Exactly. They build a city for the subcontractor, but they only keep a tiny management fee. The bulk of the money passes straight through to the sub. It inflates top-line revenue but yields terrible margins.
But the commercial pivot changes that dynamic.
Completely. Under the new strategy, especially with the complex data center work, Willdan takes on much higher-level, self-performed engineering fees. They're doing the upfront master planning, the complex advisory work themselves. When Willdan's own highly trained salaried employees do the work, the company captures the full value of the margin. No subcontractor taking the lion's share.
So as subcontractor costs drop as a percentage of revenue, the gross margin naturally expands. And the margin expansion is extending down to the bottom line too because of how they manage their back office. Management stated their administrative costs are scaling at only a fraction of the company growth rate.
If we connect this to the bigger picture, this brings us to a foundational concept in corporate finance that management is heavily relying on: operating leverage. When an analyst models out a professional services firm, operating leverage is the holy grail.
So how does a consulting firm actually achieve operating leverage organically?
Imagine you operate an engineering firm out of a central office. You have fixed back office expenses, rent, HR salaries, enterprise software licenses. Now imagine you suddenly double your revenue by winning massive commercial contracts.
Okay.
Because your core infrastructure is already there, you don't need to double the size of your HR department or rent a second headquarters. You hire more engineers for billable work, but those fixed administrative costs grow at a drastically slower rate than your revenue. Therefore, every new dollar of commercial revenue falls much faster and much cleaner straight to the bottom line as pure profit.
So as Willdan absorbs Burton, their operating leverage is supposed to absorb the overhead and push EBITDA margins toward that target. But wait, look at the specifics of Burton. They are moving from localized government work to managing 60,000 national client sites. Doesn't servicing 60,000 distinct retail locations require a massive, heavy administrative lift that could crush this operating leverage?
You've just articulated the exact structural risk that has skeptical analysts freaking out.
I mean, you need account managers for different regions, complex compliance software, tracking thousands of utility meters, billing departments, processing thousands of micro-invoices.
Exactly. On the income statement, everything looks pristine. Gross margins up, administrative costs look controlled, EPS is up 44%. But the income statement is only half the story. To see the cracks in the armor, we have to put down the income statement and flip over to the highly stressed balance sheet.
So what does this all mean? Because the story the cash flow tells is aggressively different. Despite posting record Q1 profits, Willdan posted a brutal $24.4 million operating cash outflow. They literally burned $1.71 per share in free cash flow in 90 days.
It's jarring, isn't it? It happens because you have to separate accounting rules from the reality of a bank account. Earnings per share is an accounting metric. In professional services, you recognize revenue the moment the work is performed, even if the client hasn't written the check yet. But cash flow is the unvarnished reality of dollars entering and leaving the checking account.
And the sources trace this cash burn to two pressure points: a $21.4 million swing in accounts receivable money owed to Willdan for work completed but not paid, and a $30.7 million drain from accrued liabilities, which management says was driven by seasonal bonus payouts and paying down subcontractors.
This completely deconstructs the vulnerability of their project-based billing model. They have intense seasonal cash outflows, they have to pay engineers bonuses, they are legally obligated to pay subcontractors. The cash absolutely must go out the door, but the cash coming in is entirely dependent on the unpredictable payment schedules of their massive clients.
Right, and management even admitted that cash flow would have been $18 million higher if just one single client had paid 2 weeks earlier.
Think about the fragility of that.
If a single client's accounting department paying an invoice 14 days late swings your quarterly cash flow by $18 million, how is that a resilient business model? That sounds terrifyingly fragile for a company trying to scale into the Fortune 500.
It is incredibly fragile. And the timing of this liquidity crunch couldn't have been worse because they were simultaneously trying to execute the Burton acquisition.
Right. They needed cash for the $52 million upfront payment. So what did they do? The filings show they were forced to draw $30 million from their revolving credit facility just to fund Burton amid this cash drain.
Management expects strong cash flows for the rest of the year, targeting long-term free cash flow conversion of over 70% of adjusted EBITDA, and they say they'll repay the revolver by the end of 2026.
But relying on drawn debt while burning operating cash,
Right.
that magnifies the execution risks hidden in their proxy statements.
Which brings us to the execution complexity. Integrating Burton's 60,000 sites is a massive operational hurdle. It hinges on the executive team's ability to seamlessly integrate Burton without destroying client relationships or crushing margins under administrative bloat.
But look at CEO Mike Bieber's compensation structure.
Yeah.
He has 83% of his pay at risk, with a max cash bonus of 200% of his base salary. But the proxy reveals zero specific targets for integration success or commercial revenue. He's rewarded strictly on broad EBITDA, EPS, and shareholder return.
This is a textbook misalignment risk. If executives are only paid on aggregate EBITDA growth, they are highly incentivized to ruthlessly cut administrative costs during the Burton integration to hit their targets.
Right, slash the customer service and compliance teams to inflate the quarter's EBITDA. But that risks alienating the Fortune 500 clients they just borrowed money to acquire.
Exactly. And there's another massive risk. Willdan boasts about having a $1.0 billion backlog of future projects. That sounds like an impenetrable fortress of guaranteed cash flow, but the 10K filing warns it's an uncertain indicator.
Because of the termination for convenience clauses, most of those contracts allow the client to unilaterally terminate the agreement with 30 days notice. Willdan can only bill for the work already completed.
Right. A billion-dollar backlog looks great until a macro shock causes commercial clients to instantly exercise their 30-day cancellation clauses.
It's like bragging about $1 million in casino chips on the table when the house has the right to shut off the lights and void the game with 30 days notice.
Perfect analogy.
So we have a company posting 44% EPS growth but bringing cash and sitting on a fragile backlog. How do we synthesize this into a final verdict for the listener? AI proxy or capital trap?
This raises an important question.
Right.
If we weigh the two sides, the bull case is that WLDN is a commercial masterstroke, direct asset-light proxy to the 45 GW AI energy gap, and recurring revenue from Burton should smooth out the working capital lumpiness. If management hits that 70% cash conversion target and pays down the revolver, the premium valuation is totally validated.
But the bear case says they are priced for perfection, dealing with severe working capital friction, drawn debt, and zero margin for error integrating those 60,000 sites. Do you think the market fundamentally misunderstands them? Wall Street loves software-like recurring revenue, but Willdan is ultimately a human capital, boots-on-the-ground engineering firm. Are they being mispriced because people want them to be an AI tech company?
That is the absolute crux of the debate. You cannot infinitely scale a human engineer the way you scale a software license. If the administrative weight of 60,000 commercial sites crushes their efficiency, the frictionless tech narrative breaks down.
Right.
But I want to leave you with a final provocative thought. We've talked extensively about Willdan acting as a bridge until new power plants are built. But consider the pace of AI advancement. What happens to Willdan's leverage if the energy demands of next-generation AI models scale so exponentially that energy efficiency is no longer enough to plug the gap and the grid simply breaks? Does their value skyrocket as emergency responders? Or do they get completely sidelined while the government takes emergency federal action on massive new power generation?
That is a wild systemic risk to consider. Thank you for joining us on this deep dive into the sources.
Oh.
Risk defined. Portfolio protected.